All right, good morning, everybody, and welcome to another Mortgage Coach Tuesday interview. For over a decade, every Tuesday, 9 o'clock, we are putting on a sales meeting, and the goal is always to put on the best sales meeting in the mortgage industry every Tuesday, 9 o'clock, Mortgage Coach channel. So if you're in the Zoom platform and you're checking us out from Zoom, I'll be monitoring that for questions. This will be one of those sessions where we want you guys to ask lots of questions. While Dan has prepared slides, graphs, charts, data, updates, he loves it when he gets your questions. Some of the best value comes from responding to those. If you are watching this in Facebook Live, put your questions down below. I will get to them. And if you're watching the recording, whether it's in YouTube or whatever platform, all your questions will get answered. Just put them down below. Dan Rawitch, what's up, my brother?
Hey, how are you? Thanks for having me.
You're on mute.
Oh, no, I'm not. I'm showing my mic
Dan,
working.
we lost you, bro.
Oh,
so guys, Dan will figure this out within a matter of seconds or minutes. And in the meantime, let's make sure people know how to use the chat. Let me know where you're coming live from. I am coming live out of Portland. Oh, everybody hears them but me.
Everyone hears me but you, Dave.
Are people hearing Dan? Okay, they say they can hear you, Dan. So go ahead, and it's something on my end.
All right, I'll take it from here. Now you got me. Okay,
I got you. I hear you now.
Thanks for the temporary panic there. The morning I've had, I expected it was on my end. All right, guys, good morning and happy to be here. It's been a real challenging time, I know, for all of us, whether you're trading bonds or selling loans. It's been a very interesting time. And so I want to kind of dig down and show you what's been happening and where I think that's going to lead us. I'm going to start off with some slides. I'll go through those pretty fast, as I always do. And then I'm sure that Dave and Robert will make those available to you after the call. And you can do with them whatever you want. You can make them yours. You can put your picture on them. I don't care. What's mine is yours. So with that, I'm going to share my screen, if that's okay with you, Dave.
Go for it, Dan. And guys, we want you to use these slides. Part of what we want to do at Mortgage Coach is make this content available to you in a valuable way. So the slides will be in our Facebook group. There's a section called Files, and there is so much gold in that file section. So many documents, so many presentations, so many forums. So check it out. Let's roll, Dan.
All right. So let's kind of start off with the case I'm going to make here is that longer term rates need to be lower than they are now, closer to where they were, back in the fall. A shorter term, I'll show you some charts that show that there's going to be a favorable move for all of us. In fact, those of you that were in the clubhouse that Dave invited me to last week, we pretty much called bottom to the day. We might have missed it by a day. Now, I don't want to jinx that. Maybe it wasn't bottom, but it looks like bottom. Bottom is choppy, if you saw my rate watch this morning. So what I'm going to do is support a thesis that rates longer term need to be low. Rates short term are going to drop. Rates midterm, you might see an unfriendly bounce. And so that's going to be a great sales opportunity for you to get with your clients and say, hey, there's a good move here now. We can't get greedy. And you'll actually have things to show them that are actionable, in my opinion. So it begins with, let's talk about the cycle here. Consumer confidence will drive consumption, right? If you don't feel good, you don't buy stuff. Consumption is spending. It's what we buy, and that is 70% of GDP. It is thought, an old school theory that the market is reacting to right now, is that as the economy grows and GDP grows, that it is inflationary, and that is not necessarily true. But the whole point I'm going to make is we're not able to grow GDP. We just can't, and there's too much debt. So let's get started. So these first slides are going to sort of make that point. This is the economic indicator, and you can see going all the way back to 1959 how we grew kind of slowly. But the point of this slide here is that each time when we came out of a recession, we got sort of above this red line, above the baseline of the recession. You see this? So what we're saying now is, well, the recession is over because GDP is no longer negative. A recession is simply negative GDP. So GDP goes positive, but somehow we haven't reached the same economic indicator numbers as we were prior to going into the recession. In fact, we're well below it. So this recovery is questionable, in my opinion, at best. And then productivity is the number one concern here. Think about productivity as sort of everything. If a society is not productive, it doesn't make stuff, it doesn't sell stuff, and people can't buy stuff. And if you look at what's happened to productivity, it began dropping at about right after the dot-com crash, and it just continued to come down. And then the Fed got real creative with all kinds of monetary policies, and productivity got a little bit better, a little bit better, a little bit better. And you can see now productivity has dropped, but we are still so far below where we were prior to the dot-com implosion, and we're nowhere near where we were before the 2008 recession. So productivity is going in the wrong direction. And keep in mind, this is with the Fed spending trillions and trillions of dollars. Imagine if the Fed wasn't doing that. So all the Fed's efforts are unable to create productivity. And part of that problem is, if you've listened to me for a while, you know I'm a kind of a fanatic on macroeconomics. And macroeconomics are driven by a lot of really big picture things. And one of the biggest picture things there are is our age waves. And I'm a baby boomer. I was born in '58. I'm a young baby boomer. It's the only thing I'm young at. But so you can see here, going back into the '60s, just after I was born, the age wave. So this is telling you that 35% of the population was, where are we? The average population, sorry, was 37 years old. And then as you got into 62, 66, 68, 70, population was aging. And then by the 70s and 80s, population had reached 50. And as the population was aging, inflation was growing. Because as we got older, we made more money, we were more productive, and as we were more productive, we were driving inflation. That's when GDP and productivity used to mean inflation. And then 1980 came along, and the world's really never been the same. Then the age wave started going the other way. The population started going older, and as that happened, inflation started going down. And so you can see. And better, you can see this as how that has created the bond yield. As the population has aged, bond yields have gone down. And that's probably not going to change. Here we see the inflation rate where the Fed needs to get, Fed's shooting for 2.4%, and he wants to keep it there because he needs to overshoot it because we haven't been able to stay there. If you go back to 2008, again, going into that Great Recession, we really haven't been above 2%. We got above there slightly in 11 and 12, and the Fed had a knee-jerk reaction. They raised rates a little bit too much, and you know what happened in 13? You can see just the slightest bit of moves have taken inflation down too much. And now here we are, way down here. The Fed has a lot of work to do to get us up where we want to go, and you're certainly not going to get there with rates being too high. In fact, we now know that even 0.5% 10-year bond is not going to get inflation where it needs to go. And there's reasons for that we'll get to. This is personal consumption. We talked about consumption being the stuff that you buy. And you can see that the consumption number here is at the zero baseline. And it's done nothing but go down since 2018. If you were following me back in 2019, I was really beginning to ring the bell saying, guys, we're getting into some trouble here. This is not good. This is before the pandemic, actually. We were really heading in the wrong direction. And then, we fell off the cliff. Things have gotten better, but we're nowhere near where we were prior to the pandemic or 17 and 18. So you keep hearing all this stuff about the economy's doing great and da-da-da-da. Sure it is. If you want to compare things to where they were just as we came out of the pandemic, down here. When you start comparing numbers, from here to here, yeah, they look good. But what you need to do is compare numbers from here to here before all the problems started. So it's still not healthy. Once again, every one of these slides is to make the point the Fed has a lot of work to do to get us where they want to get us. We have rents declining for first time in many years. Rents just kept going up and up and up. That's deflationary. That's going to hurt landlords. It's going to hurt commercial buildings, etc. It's certainly not going to help inflation. We don't want that kind of inflation. Personal consumption expenditures on services. So goods. Here's what happened during the pandemic. We didn't have anything to do. We didn't have any place to go. So we just bought stuff. That's why Amazon boomed, and all these e-commerce companies just went crazy. But the services sector of the economy, which is 30% of our economy, is just terrible. Look at how bad it fell. And it really hasn't recovered much since the pandemic. So we have rent and services, two very important parts of our economy, have not recovered. And we have consumption that really hasn't recovered. It's done better than services. And the Fed knows this, but the stock market is in this complete denial, and people keep confusing the stock market with the economy. So this is the global growth barometer, and that's the blue line, and the red line is the S&P, and this goes back to 1998. So you can see back in 98, the growth barometer was, kind of climbing. The stock market was climbing. And that was all okay. And then it all came crashing down together. And then they rose together. This is exactly what's supposed to happen. Economy grows, stock market grows, and then it all stopped. And then we could no longer grow the economy. And yet the S&P has just gone up and up and up and up. This divergence is extremely deadly, in my opinion. This is where all this disconnect is. How can this be here when this is here? And this is why I continue to refer to the stock market as a bubble. By the way, I completely changed my stance. I do not think the stock market is going to crash. I think there's a big correction coming, and I'll show you that in a few minutes. But as long as the Fed keeps doing what they're doing to try to help this and to keep interest rates down, it's going to continue to bring the stock market up. The other issue here with productivity, and I don't know what the solution is, and it's gotten way worse since the pandemic, is full-time. People don't want to work anymore. This is the full-time employees as a percent of the total population. And you can see that essentially since 1999, again, the dot-com crash, the percentage of our working force just keeps going down, down, down. And this slide's actually a couple of months outdated. It's dropped again. So we have only 47% of our able working force working. Wow. China is now really starting to deal with this problem because they not only have an aging population that can't work, doesn't want to work, they have the one baby law. One baby. They're really suffering from that. That Japan has suffered for 20 years because they had the one child law. You have to have a growing population, and you have to have a population that wants to work, or you can't have productivity. If people don't want to work, they don't have babies, and population doesn't grow, the economy can't grow. I think it's pretty simple, right? People are customers. And that's why I'm a huge fan of immigration. We have to have immigration, but they also have to contribute to society. So I'm not going to get political there. I don't care how they come here, as long as they contribute to our economy, whatever that takes. Okay, so now let's get into interest rates a bit. Our market mentor membership members have been hearing me talk about this for a while. And by the way, you'll hear me talk about our market mentor members a bit. If you have any interest, there's a word missing here. We have an offer. It's offer.marketmentorship.com if you want to check out what we're doing. And you'll see some of the tools that they get to see on a daily basis.
And guys, we're gonna put a link to that. It's an incredible platform that Dan puts a lot of love into. So, I mean, as you guys know, Dan has been the chief economist here at Mortgage Coach for over a decade. And now he has something. So if you want to have a more intimate relationship, a day-to-day chat available to Dan, and all the details on it, just check out the link. We put it in both channels. Check it out. And he'll tell you more later on.
Thanks, Dave. Yeah, and I consider our members, this sounds almost trite, but it's true. They're my friends. We communicate every day. It's like any other thing. There are those that are super engaged and super active, and those are my friends. And then there are those that they read and they use the service, but they don't engage with me as much as I wish they would. Okay, so if you look, a lot of people don't. So most of you know what the VIX index is. The VIX index is the fear index. So investors, if you think the stock market is going to crash, or as it's crashing, you'll buy shares in VIX. You kind of don't buy shares in VIX, but you buy the VIX, and the VIX will skyrocket when the market goes up. So that is your pink line here. In fact, our members, we bought the VIX here just as the pandemic was happening. We had a couple members make over $100,000 in this move. That the VIX moves so incredibly ferociously when the market crashes that it's a huge opportunity to make money. Well, what a lot of people don't know is the bond market has also a VIX index, and it's called the MOVE index. And it really does tell us in advance when there's trouble coming. And I began talking about my concerns about the bond market in the summertime, kind of August, September, because the MOVE index started creeping up and it wasn't making any sense to me. And it was coming up while the VIX index was coming down, and they don't usually diverge that much. And that was about the time that we started seeing the treasury market just kind of come down. It was like a slow, painful bleed. It didn't crash all at once. But I'm going to show you kind of where this leads in a bit. But I want to see, we did see this coming. We did have the tools to know, just as we did well before the pandemic. You can see the MOVE index telegraphed this before the pandemic back in December, well before the VIX, well before most anything. It's a great index. Okay, so this is the, these are actually this is the 10-year yield. Now, 3 times in history, 2 times up until now in history, have we seen moves this large. This might be one of the greater takeaways of the day. And you can see that, how many of you were in the business in 2013? So I was in the business. I was running a pretty large production team, like 300 million a month. And I just, printing money and loving life, and things were so good. And then one day I woke up and we weren't doing 300 million a month, we were doing 180 million a month. And I went from hero to goat. Luckily, the whole company went from hero to goat, and management team went from, all happy and parties. I remember an event. It was one of these quarterly meetings we had with all the executives. And all of a sudden the CEO said, by the way, all these massages and rafting trips and all this you signed up for, you're gonna have to pay for those yourself. Like, what? like, I hate to admit this, but I probably would have signed up for a $500 rafting trip or a $400 massage. You guys offered it. Oh my God. So that's what happens in our industry during bad times. So it was brutal, and it happened so fast. But then what happened afterwards? We got this big drop, and then we got this bounce. I want you to remember that. Big drop, worst bounce, and then we worked our way down, and then we got another drop. I want you to think about waves. Huge up wave, down wave. We took a big deep breath, and then we got crashed by another wave. Down wave, up wave, down wave. The market moves in waves. We're going to talk about that a lot. Then it happened again in 2016. This massive wave came, it crushed us. Then we had this beautiful down wave, and then boom, it happened again. This was about the election period. And then that next wave was just beautiful, 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 beautiful. You guys got to admit, this was due, right? And we kind of did see this coming, because this is about when the MOVE index started. Where are we? Q1, Q2. Right about in here was when that MOVE index I just showed you started happening. So my theory here is you're going to see something that plays out. I don't think it's going to be this bad, but you are going to see kind of a pullback like this in yield, and then the next wave is probably going to look like this, and then I do believe you're going to see a pretty good down wave. We'll get more detailed on that soon, but I wanted you to see what the past looked like. And this is very similar, but this talks about not the move itself, but the rate of change. Rate of change is something traders look at, because the move is one thing, but how fast did the move happen is as important. So you can see during that same period in 2013, this is the bond VIX. So this is the move index. You can see how it went straight up in price, and the rate of change was just as horrid. Same thing in 14, we had this kind of big move here. Rate of change was pretty big. And then in 2020, but this one, the rate of change has been greater and more severe than prior to the pandemic, more than the 2014, and even more than the 2014 move. So while the spike has not been nearly as bad yet as what we saw in the pandemic or the 2013 move, the rate of change has been the worst that we've ever seen. Keep that in mind. And this is a good slide to show your borrowers. This is why there's so much fear out there right now. It's this ROC is been painful. Is that the same slide? No. So for you stock market fans, this is very worthy of note. Every time that this ROC has peaked here, here, and here, the S&P bottomed. Okay. So we have now, if you take this forward, we have this ROC up here. We have this S&P pulling back. We don't know that the S&P is through pulling back, but if it is, oops, sorry, it's pulling back again today. But at some point, as this ROC peaks and starts coming down, and I think it's happening now, it might mean the bottom of this correction for the S&P. And that's I continue to be pretty bullish on the stock market, but I do think this pullback's got a little bit more to go. Another reason why I think this whole pullback, or sorry, when I say pullback, I'm talking price, and when I say increase, of course, I'm talking yield. There have been a couple times where the Fed got a little bit stupid, in my opinion. I gotta move this real quick. And again, I've been in the business a long time, a lot of times as originator, many times running companies or production teams. So think about the 1990, 1991 recession. This is the green line. Now down here, this is the number of weeks around the end of a recession. This slide can be confusing, so you have to sort of look at it for a minute. So the green line is 1991. And what this is telling you is the rate volatility starting here about, call it 50 weeks after the recession. This is when the rates started kind of doing their thing. And 94, the Fed started hiking rates. So the Fed rate hikes in this particular case started 160 weeks after, gosh darn it, sorry, after the recession. So the Fed left things alone for 160 weeks, and the rates really didn't start peaking until 160 weeks. Then you had the 2013, remember the taper tantrum? That's what caused that pain we felt during that last slide I showed you. And that taper tantrum didn't occur until 208 weeks after the recession. And now we have this huge rate increase coming just 40 weeks after the recession. The spike we had before that, which was just really a very short-term spike just before the pandemic, that occurred 8 weeks before the recession. So what's the point here? The point here is this makes no sense. If you're going to get any kind of a rate increase that's sustainable in any way, shape, or form, it needs to be, if you look at historic 160 to 208 weeks after a recession, not right after a recession. It's too soon. Okay, so moving away from rates, talking about gold now. Gold in many ways is signaling zero concern about inflation. I do think, by the way, gold is an absolute great buy. We're going to be taking a pretty big position in gold. But gold is an interesting instrument. So number one, I think gold has been telling you they're not concerned about inflation. It's just been continuing to go down. That's one point of the slide. 2 points of the slide is I want to help you guys make money. That's our market membership. Our market mentor membership does two things. One, it helps you hopefully be smarter. It helps you have talking points to talk to your clients every day. It helps you be able to speak to realtors, understand where rates are going, but also provides you tips to help you make money. And I'm going to show you some of that. Every week I do a weekly video I give you stock tips. I'll show you this last week, as of yesterday anyway. 7 for 7. I gave 7 stock tips on Sunday night, and all 7 of them had gone up. The worst tip was up, I think, 3.5% yesterday. The best was up like 13%. But gold's going to be the next big move. But gold's not going to have a big jump because of inflation. Gold's going to have a big move just because of Fed stimulus and concerns about the devaluation of the dollar. Stimulus does not equal inflation. It just doesn't. It does not equal economic growth either. I hope I kept those slides in here. So gold, don't forget gold. Silver, huge move coming. You know, silver right now is 24. I think it's going to go 35 to 48. I can show you how to just use call options to buy silver. I have a pretty good position in silver right now. Reddit, if you guys haven't followed this, Reddit has a subreddit group called Wall Street Bets. To me, they're kind of knuckleheads. They get each other all pumped up. They all get together and decide what stock they're going to hype, and then they try to run up a stock. They basically in mass manipulate a market, and it's a greater fool's theory. They just try to get the last guy in. They all try to run up the stock price. The last guy in loses because the first guy's in, get out, and make a bunch of money. And then they tell everybody else, hold strong, so they can get out. It's terrible. But now they did a GoFundMe site. They raised money to buy a billboard to try to get a bunch of people to buy silver. So I haven't found a silver outside of Reddit, but Reddit's going to help run up the silver position. So you might check out SILJ is probably going to be something that runs quite a bit. Energy is also going to run a ton. UNG is a symbol you definitely want to look at. I'm nervous that I didn't put these slides in, so I don't want to miss talking about this. This $1.9 trillion package is going to pass, right? And I've got a bunch of slides. I may pull them out. I might even make sure they get in this deck because this is a really old false belief that goes way back that stimulus is inflation, creates inflation. Well, it doesn't. Stimulus is debt. And I'll ask you this, if you go out and you spend a bunch of money and you get a big fat house payment, you get a couple of big fat car payments, and you're making a bunch of money, and then your income drops, think tax cut, or tax increase. Are you spendy? Are you then thinking about an Armani suit? No. In fact, you're going to tell your spouse or your significant other or yourself, I just bought that car. I probably shouldn't be buying a new outfit for a while. I probably shouldn't buy that new Mac. I just bought that car, right? I mean, that's how it works. You don't take on debt and then go buy stuff. Well, the government's the same way. The debt is a tremendous drag on our economy. Debt has never, ever created growth. It's a giant parachute behind, the ship. So, and you can go all the way back to the Great Depression. Every time that the country has created debt or tried to stimulate the economy has gone down, not up. So, and yet it's this vicious circle because the more they do it, the more they have to do it. We cannot, since 1990, the more the Fed stimulates, the worse it's gotten. And what it comes down to is, as the more money into the system, there's something called M2. M2 is the total supply of all the money in the system, all the banking, checking accounts, savings accounts, money market accounts. And so you would think with all that money flowing into the system that it would be inflationary, and it could be. But then you have something called money velocity. Velocity of money is how much the money's moving around in the economy. Well, as the money's moved into the system, the velocity of money has come down. It literally, if you look at the chart goes up, velocity comes down. Velocity of money has never been lower. Every dollar the money supply grows, the velocity goes down, meaning all this money is just stagnant in the economy. The system is telling the Fed, you're doing too much and we don't trust it. We don't trust you, and we're not going to spend this money, and therefore we're stagnant and we're going to grow. And I don't know why the Fed keeps trying, but they're going to keep trying. So I have zero concerns about inflation. I have massive concerns about deflation. And we have a huge model, and that's Japan. We're doing everything Japan did, and Japan had 20 years of deflation. I realize that this is a contrarian point of view, but I can show you charts that go back to the Great Depression to prove my point. And we have our own proof now, going back to 1990, that we cannot get inflation above 2% and we cannot get GDP above 2.5%. It just hasn't happened since well, certainly since 2008. So I want you to keep that in mind. We're going to see things that might look like we have inflation. We're going to see, oil jump up in the summertime, which I think you want to take a part of that. We took a big position in XLE, which is an exchange traded fund. It trades just like a stock. You buy it just like stock. It's going to go up like crazy. I just noticed yesterday, George Soros, who is one of the wealthiest hedge fund guys in the world, obnoxious guy, but he just bought 2 million call options on XLE. UNG is another energy stock symbol. It's going to skyrocket into the summer. I think it's going to, probably go up 40, 50%. These are things you definitely want to look at getting, and they're inexpensive right now.
Hey,
And then,
Dan, someone just asked the question, what trading platforms do you suggest?
so I can give you a link. I'll stick that in I'll get that to you guys. But I use Tastyworks. And the reason I use Tastyworks is we trade options and we trade stocks. And Tastyworks, they have the best content for people that want to learn options. They have the best platform, the best technology, and the best service and great prices. So that's what I really love. But yeah, I can get you a link.
Hey, Dan, I was on a Clubhouse conversation the other day. And by the way, thank you for participating last Tuesday, I think it was, in the daily Mortgage Coach Clubhouse. But there was mortgage professionals just talking about, hey, we got money. We want to invest in real estate. We want to invest in stocks. And then Robinhood came up. There was, obviously they were big in the news recently. What are your thoughts on Robinhood? The trading platform.
Oh, you're asking me a question?
Yeah, you. What are your thoughts on Robinhood, the trading platform?
Oh, so I think Robinhood's okay, but I have a problem with Robinhood. I don't know if you heard, what Charlie Munger said. Charlie Munger is Warren Buffett's partner. He's 97 years old. The guy is sharp as a tack. He's my hero, as is Warren Buffett. And what Charlie Munger said, I agree 100% with. He said, it's a shame that Robinhood has taken an entire generation of smart millennials and turned investing into gambling. Because Robinhood, when you make an I actually downloaded the platform, I put money into it, and I made some investments just to see it. So, because I don't want to be critical of something I haven't used. I bought some crypto, and like a champagne bottle popped, and confetti went up in the air. What the F? Are you kidding me? Is this a game? I found it very offensive. This is not a game. This is our life. This is our retirement. It's not supposed to be fun. It's serious. So can serious be fun? Yeah, I think we make it a lot of fun in our group, but it's not champagne bottles and confetti. And when you suddenly see a position down 30 or 40%, I don't think you feel like seeing confetti fly. So I think their functionality is average at best. Their customer service, my opinion, was horrible. So yeah, I'm not a fan. It's average at best.
Got it. Thanks, Dan.
Yeah.
And guys, keep the questions coming. There was one more question I just want to get real quick from Gary Fish. He said, hey, ask Dan, the rate watch numbers on opening, the high and the low and the closing, is that the price of the bond or the yield?
That's the price of the bond, not the yield.
Got it. Price of the bond, not the yield. If you need more help on that, Gary, let us know. By the way, Gary also said some really nice things. He said, I've been a member of Dan's Market Mentor since January, and it's a big win. So very cool. Thank you for that.
Gary. Next month free. Send me an email.
Yeah, and Kyle Allen, thank you for the question on what platforms to use. He did mention that he uses Fidelity. Any comments on that?
I don't know Fidelity well. Here's the deal. So the most popular options, and you remember, I'm more of an options trader than anything else. And we just had a new class, and it was a great experience for them because we took an options position in MRO, which is Marathon Oil, and we bought it was a tiny position. We bought a call option. The option was 56 cents, which is $56, because when you buy one options contract, it's like controlling 100 shares. So $56. We could have bought 100 shares for $1,400. The next morning, we sold that same contract for like $180. So it was more than 3 times our money, and we would have sold those same shares for like $210. So we would have made $70, but in one way we made like 3 times our money. The other way we would have made 30% return on our investment, and our members just got it. Wow, I get the leverage, and the most you could lose is the price of the option. So there's so much leverage on options, and they're so much safer. But yet options have this crazy reputation because of companies like Robinhood. They make it look risky, in my opinion. So Tastyworks, in my opinion, has the best options platform I've ever seen. Ameritrade, they have a platform called Think or Swim, which is very famous for options traders. But in my opinion, it's very old school. The guys that built it sold it for $300 million to Ameritrade, and then they started Tastyworks. They're hip, they're cool. They have like talk shows every morning. They have a whole team of analysts. Their analysts every morning will present the best trade of the day to their CEO. Their CEO will listen to their trade. If he likes it, on the screen, he'll be taking the trade right in front of them. If he doesn't like it, he'll be like, I'm going to pass, and here's why. And as traders, you're learning from listening to this guy. Or you go to Ameritrade and you don't even know who the CEO is, and try holding for their customer service desk someday. At Tastyworks, I get messages every day from our members going, I had this problem happen. Their help desk picked up the phone within seconds. So I think Tastyworks is a blend of hip, but not so hip like Robinhood, and traditional in terms of customer service, but not stodgy like an Ameritrade or Schwab. So
Cool.
That's why.
Good.
But Fidelity might be good. I don't know.
Yeah, no, good stuff. And there's a few people that did shout outs for Tastyworks, and a few people that are like, I'm setting it up now. Hey, Shayla Gifford just jumped in and she posted, hey guys, I missed the first 15 minutes, but I'm gathering that we're expecting a rebound a bit from here, which would mean lower interest rates, and then wave spikes again, basically a roller coaster, and then possibly rates will come back down. Does that wrap it up? Is that fair enough, what Shayla just said?
Yeah, Shayla, thanks for stealing my whole show. That's right.
Yeah.
You're fired. So, yeah, that's it.
So netting it out, we're going to have ups and downs all year, and you do believe we will, the lows we've seen, we will see again. It's just a question of when.
That's right.
He's nodding his head.
Right.
Well, hey, keep giving the slides, keep giving the details. Shayla, if you want to join me on stage, I sent you a panelist link. Feel free to come in and we can beat up Dan together. Let's keep going through your slides. Remember, guys, put your questions in. I'm monitoring both Zoom down below. I'm monitoring Facebook. And once this is live as a recording in our YouTube channel, we'll make sure all your questions get answered. Just put them down below in comments. Keep it rocking, Dan.
Okay. So, and then I want to share, like, in terms of, investment strategies, one of the things that I always try to think about is, what's different, because the world is changing, and the Amazons, and the eBays, and they're going to continue to be great, and the Zooms, but there's all this new stuff coming, and some of it's going to be as big or even bigger. The space technology and the robotics and the autonomous cars and even the flying cars, all the stuff we laughed about many years, it's really coming. And I spend so much of my time researching all those new technologies, but without getting too far out there, just some real simple things to think about. Just think about just coming out of the pandemic, some structural changes. So supply chain moving back to the USA. So think about the rationale from China to the USA. You're going to have a lot of companies that have capital stranded in foreign factories, foreign supply chains. You want to look at companies that have new capital in domestic factories, domestic supply chains. That's easy to figure out, easy to find. These are companies that are going to really take off. Whereas a couple of years ago, we looked at companies that had a lot of their money invested outside of the US. Deurbanization. companies that have a lot of capital in cities and suburbs, they're going to have money stranded in urban restaurants, urban shopping, city-centric services. Now you want to look for new capital in housing and furnishing, infrastructure, home entertainment, home delivery, suburban entertainment, suburban amenities. So think Dash, you know where that's all going, right? And that also does continue to play into some of the Walmart new technology and Amazon as well. Work from home, office space, Midtown, that's stranded capital. Home technology, home furnishing, US-based assets are going to be where the new capital goes. Violence in cities, you're going to see stranded capital in cities, and you're going to see new capital creating distance from cities. Autonomous cars and homes, personal security, weapons. And to that point, what I started thinking about was, what will you be thinking? Theme parks are booming. Am I going to buy Netflix? No. People are back to the gym. Am I going to buy Peloton? No. I'm going to take my first trip in a year. Am I going to buy Zoom? No. So you can see there's going to be a shift in both the mindset of consumers and investors through the mid-year. And I think it'll show up in the consumer's wallet and in the equity investor decisions make. And so I started kind of putting together what I think is going to lag here in terms of what sectors and where I think things are going to move. By the way, I think the energy sector, you're going to see major FOMO here because people are really going to start moving a lot. Airplanes flying around again, cruise ships moving, cars driving, financial sector starting to move a lot, discretionary spending starting to come a lot. And this is a list of stocks that in each of these sectors that I think are going to boom, these are stocks that I think will all do real well. Now, I wouldn't go crazy in any one of these. I would take a couple in each sector probably.
Hey, Dan, before we move off this, and if you're going to tell me you've got this at upcoming slides, just kick the can. But where do you think investing in real estate, whether that's buying investment, moving up, or a second home, where does that fit, in this year from an investment perspective?
So, I think that the from a stock market perspective, I think the builder stocks are going to kill it. I think builders have this amazing opportunity that they've dreamed about because they're able to buy land now outside of, you think about it, wherever you live, like I think about, say Orange County, the cities that were outside of Orange County that people hated to commute from, let's say Corona or Riverside, that suddenly become very desirable. But even what's outside of Riverside would be like a Norco, which would be completely unacceptable to drive from. All of a sudden that land's going to get gobbled up because people will live in Norco because they don't have to commute anymore. They can work from home. You're going to start seeing homes pop up in these areas like Imperial County. So I think if you start thinking about those areas, that's where I'd start thinking about buying homes and buying rental properties, especially start looking for new homes and start grab some of that up.
Yeah, but like I said, I'm seeing, a lot of mortgage professionals are sitting on a lot of cash. They want to invest. Should they invest in stocks? Obviously, diversification makes sense. But also, do you think we're going to see a good spring home buying season? Do you think we're going to have a lot of move up buyers and people buying second homes or moving? What are your thoughts on that?
Yeah. So what I'm saying is, because I think the builders are going to start building outside into the outlying areas, I think that's where the opportunity is going to be to buy homes. I think that people, here's the way I look at it. I mean, there are people that are just going to want to live in Newport Beach, right? They can afford it. It's a nice area. That's maybe different. But do you want to live in Los Angeles? Probably not. Do you want to live in West LA? Maybe not. Maybe you have to because that's where you work. So those are the areas that people may want to get outside of. Maybe they want to get into where they have some acreage and it's going to be much cheaper. So I think that's where the opportunities are going to be. I think the second home market's going to explode. I really do, because people are going to be able to spend more time in their second homes. They're going to be able to work from their second homes. So absolutely. I don't know enough areas outside of where I live, but I know in California, like Lake Tahoe is just exploding. Truckee, California is ridiculous. I'm guessing like
Shayla Gifford, you like that, Shayla? I was just doing a shout out for Shayla because you were talking in her backyard. Hey,
I mean, don't you think, Shayla, like Truckee right now and Squaw Valley and you know, even the hilly, what I forgot where the nicer parts of Reno are up in the hills where they're
Incline
building.
Village.
And Dave, where you are, Bend, Oregon, and Sun River, and you know those areas where outside of the metropolitans, I think they're going to really explode. So yeah, I think those are going to be good areas.
Cool. Well, hey, Dan, we got 15 minutes left. I also want to make sure that you talk a little bit about Market Mentor. So wrap up on the slides, and then I will, bring in any questions that we have.
Okay, so let's see what I got left here. Okay, so yeah, let me quickly talk about Market Mentor and but before let me go through some quick slides. No, you know what? Before I do that, because I have time, I think I want to show you just a couple of the tools that we use in Market Mentor, and some of the things that we look at. And I want to use these too, not necessarily to show you Market Mentor, but to show you where I think rates are going short term. I think that'll help you. So one of the tools that we use before we pick a trade is called Elliott Wave. Elliott Wave has been around, longer than I have, and I mentioned earlier on, I want you to pay attention to this because everything moves in waves. And I know this can be a little bit hard on the eyes here, but if you look at the screen here, you can see a bunch of things going on here. There's a number 1, number 2, number 3, number 4, number 5. Now, this number 1 that I'm holding my mouse on is an impulse intermediate wave. And as I hold my mouse on it, you can see there's a shaded blue underneath it. And that shaded blue is showing you that it's going to go down to a price of about. So this was a projected wave back, well before it happened, that the Elliott wave was projecting a move down to $38, and you can see it hit it just perfectly. So we knew this was a mathematic calculation that was done based on all of this stuff. Now, technology allowed this to happen because in the old days, I had to take all of these waves going back as far as I could and calculate the ratio of this wave to this wave and the volume of all these trades from each wave. Because what Elliott wave does is it calculates human emotion. And Dave, you heard me say this, and you like this in the clubhouse. Elliott wave to me is like a high school party. And a high school party starts off with, we're down here, and I whispered to the pretty girl in the English class, hey, my parents are out of town, I'm having a party, right? Because it's the only way she'll possibly even talk to me. And so she goes, okay, can I invite my friends? So I hope you do, right? And so she tells her friends, right? And all of a sudden, a couple people are getting interested, and then she tells a couple other people, and then they tell the football team, like, I'm not going to Rawitch's party, he's a dork. And then it goes on, and then a couple of people, let's give it a chance. And then a couple other people, and all of a sudden the party starts getting traction. And then people start showing up at the party, and the party starts getting hotter and hotter and harder. And now the party's reaching full cycle, and it's hot as heck, and it's getting hot, and now the police come. And then everybody starts bailing. And when everybody bails, you think the party's over, right? But then police leave. Few of my best friends stay around, and then word gets out the party's still going on, and it gets even bigger than before. So Elliott wave does just that. It's constantly calculating the how hot and how cold the party is, because the party never dies. The party always goes on, and the party continues to move in waves. So Elliott wave is calculating human emotion in terms of when people are moving in and out of a security. So and there's different waves. So what you're seeing in this case is an intermediate impulse wave. You're seeing these ABC waves. These are minor zigzag waves. This silver are primary impulse waves. So now what we're seeing here is XLE, which is something I suggested that you buy. And you can see here using Elliott wave, the current wave that just ended is 4, and that's an intermediate impulse wave. And wave 5 is supposed to take us to 56. The stock is currently trading at 47. And this wave 2 is supposed to take us to wave 3. Sorry, this wave, I already said that. So let's put in TLT. let's put in the TLT bond, and we can see what's happening right now and where that's supposed to go, because it's pretty damn accurate. And you can take it back and you can back check it because you can see how accurate it was going back into time. And I don't have to spend hours doing this anymore because Elliot, the technology now does it for me. So I won't go all the way back because we're really short on time. But what I can tell you is if I put my mouse here, you can see that one of the problems that started was this wave 4. You see where that gray shading is? Wave 4 was supposed to end at a price of about 147. And you can see that we ended up all the way down at 136. That wave was really overshot down here to wave 5. That was the bad news. But wave 2, and wave 2 was supposed to end at also at 147. So that was also the bad news. So this whole thing was never supposed to happen based on all of these old parties, everything that was supposed to happen. But now here we are, and if you look at wave 3 is supposed to come up to 148. And I fully believe that's where we're headed. You see it actually says 145 to 148.73 is where wave 3 is supposed to come. And you can see we bounced pretty well from this level here. And then also this wave, you have this is a primary zigzag wave we're in now. So you have this primary, this is the most important wave, by the way, this 3, this is a primary, this is a cycle impulse wave. These cycle waves are the biggest ones. It comes down, and then everything else is like secondary to that. You have this impulse wave, primary, you have a cycle, and then you have these little zigzag guys. Little zigzag guys telling me that A came to here, B, it nailed it perfectly, and C is supposed to come between 146 and 147. So 2 things to take away here. Let me see if I can actually, let me click
Yeah,
here.
while you're figuring that out, I just want to know who else loves the house party analogy. That's you just confirmed why you are my favorite chief economist is I love that.
Thanks, Dave. So what the current wave analysis is telling you is the cycle wave was telling you that the low would be here, and it nailed it, and the high will be in this range here. And then the zigzag wave was telling you the low would be here, and it nailed it, and the high will be here. And that's why I'm highly confident that we are on our way up until this 145 to 148 level. So that's another, what, 5 to 8 point move. That's all good, right? The bad news is that this current wave that's going to take you up to here, it doesn't end well. So if I click on this, it'll project forward. 3, where'd we go? Hang on, let me get rid of this here. What happened? I did something wacky, sorry guys. A, B, C, good, okay. Okay, here we go. So this is good, right? We want to be up here. This is good. We want to be up here. This is going to be where we go next. And then we come down here. But this ends a 5-way, really ugly cycle that started way back in the summertime. And then I believe we begin a new cycle up. And that's kind of summarizes exactly what Shayla said. We have a bounce coming up, and this is what I'd be talking to your clients about. Good times followed by a rough cycle and then back up again. So I this is bottom.
So netting it out, we're gonna have even worse rates this year at some point, and we're gonna have even better rates. So that's netting out what you think is gonna happen throughout the year.
Correct.
Got it. So guys, it's never been more important that you give clients clarity. You help them make decisions. I think it's a safe bet. Rates are going to be worse, and they're going to get better, and they're going to go up and down. But if you use the total cost analysis, show them a cost of waiting analysis. We're seeing a lot of mortgage coach professionals because it's low inventory, houses aren't appraising. People are having to pay more than the list price, more than what it will appraise to get it. So it's never been more important that you're a black belt at advice. So Dan, let's make sure everybody knows about Market Mentor, and then we do got some questions. And once you cover that, we'll go from there. But guys, this is super important. Being a mentor, being able to help a family understand that rates change, not daily, but hourly, being able to do that concise, and then having Dan as your mentor so that he's always available, I think is super valuable. So tell us about it.
Yeah, and real quick to that point, I would add, just recently I offered to our group, and I want to do this on a regular basis, to start doing monthly home buyer or realtor webinars. So you get together as many homeowners as you want, as many realtors as you want. We'll do it for as many of our members as we want, and start doing monthly webinars. Keep it real simple, real basic, and talk about the housing market and interest rates. So you be the hero. We kind of give away tickets, and I'll be the speaker. Okay, so basically the whole idea here is to elevate yourself from being a loan officer to a financial professional and a trusted advisor. Know what I know, share what I share. I provide content on a weekly basis, usually 3 to 5 times a week. Really good shareable content that you can share on your website, share on your Facebook page, etc. So you don't have to go look for content. I share blog posts that you can personalize and make your own. You get the Rawitch app, which if you're a Mortgage Coach member, of course you have anyway. If you're not a Mortgage Coach member, you'll get this for free. It's, to me, I think, one of the better apps on the market. You'll know how to read a chart. You'll know how to read the direction of interest rates in 2 minutes or less. You'll understand candlestick patterns. You'll understand trends, and you'll understand support and resistance. And I think that's super valuable. And you'll be able to explain it to clients in plain English. So the benefits are, you'll get 2 daily updates. So you're always in the know. I do morning near the market open, and I do when the market closes. So you'll be able to do the same for your clients and realtors. You'll have content to share with your clients. The weekly economic video, I think, is probably one of the best things I do, because not only do you get shareable information, you get a deck of about 60 slides that you can personalize, and you get stock picks, which will make you money. You get the Rawitch app, you get access to the private members only Facebook group, you get chart reading lessons all the time, and it's $24 a month. The Rawitch app alone, if you don't have that already, is probably double that. I think that's about it. So, oh yeah, and then I was just going to show you. So some of the stock picks. This was just this week. So yeah. So Sunday I said, buy this one. If the buy zone was between $36 and $39, and then as of yesterday, the stock was up 9%. And then on Sunday I said buy OIH, and then yesterday it was up 5%. And then I said buy XLE on Sunday, and then it was up 3%. And then I said buy. Oh, and then I said why? Why do I think oil is going to go up? And I gave more reasons why oil. I said buy DraftKings on Sunday, and then yesterday it was up 11%. It's up another 9% today, by the way. And then I said buy Fuel Cell on Sunday, and then yesterday it was up 10%. I said buy Hymex, and then yesterday it was up 5.5%. I said buy AFI. Oh no, I said buy those if they got above. They didn't. I said buy SRT in this zone, and it was up 8%. I said buy pizza above 98. Oh, it didn't get above 98, so you didn't buy it. I said buy CELH, and it was up 9.9%. I said buy TCF, and it was up 3.5%. So I was 7 for 7 on my weekly newsletter for $24. You could have bought any one of those and made 1 year. You could have made about 10 years worth of your membership fee. So I think it's a pretty good deal. And so that's offer.marketmentorship.com. That'll take you to it. It's month to month. There's no long-term obligation. I think it's a no-brainer.
All right, guys. So if you can stop sharing your screen, Dan. So guys, you just got an hour of value. You got some incredible charts. If we did not get to your question, or if you're watching the recording, Dan will monitor this in our Facebook group. So put your questions in the Facebook group. I do think I got all the questions in Zoom. I do want to remind everybody, next Tuesday, 9 o'clock is Scriptapalooza. I've got some rock star mortgage professionals, all have done over $100 million a year in production, and they're going to be sharing scripts. Denise Donahue just said, hey, I'm getting a lot of people asking me, do you think it's a good time to buy in this low inventory market? And she's going to tell you what she's saying to people and how she's saying it to people. So don't miss this time, 9 o'clock. You do need to sign up for it. There's a link in our group somewhere. So it's all over social media. Sign up for that. And then guys, be a market mentor. Dan has volunteered his time for over a decade in the mortgage coach community doing daily updates. And he's still doing daily updates. But if you want to have a direct access to him, if you want to have some of the marketing messages, and then those stock tips, you be a market mentor. Connect with Dan. Dan, I would love the idea. I've had a number of top mortgage professionals that say, hey, I'm investing. I think it would be cool if you and I together hosted some masterminds on just investing. And we talked about rental properties. We talked about second homes. We talk about stocks. We talk about everything. Would you be up for hosting some small masterminds with some mortgage professionals around that?
That'd be fun. Yeah. I think people have a lot of money, and I'm a fanatic about compounding your money. And, I have some interesting charts to show. If you just put a little bit of money away at the kind of returns I'm seeing, how wealthy you could be 20 years from now.
So maybe, we'll do that through Market Mentor. And Keith Collins, if you're watching this, I think you were one of the people that asked me about that. I'm going to hand that off to Dan. I really don't think that's my wheelhouse. I am more the sales and marketing guy, and I'm Mr. Advice. How can a mortgage professional give more than a rate in a fee and a closing cost? And if you're just giving a family a fee worksheet, you're not serving that family at the highest level. They need to get options. They need to have the transparency of those options over time. And then they need strategies to pay off their home faster or to invest that money, like, hey, pick one loan versus another and invest the difference. So Dan, you're a huge gift to this community. I'm super grateful for you, bro. And this is a wrap. Take care, everybody.
Thanks, Dave.
Give us a like, share it with your mortgage friends, and let me know if you like that house party analogy as much as I did.
See you guys.
High school in the 80s in Huntington Beach, and I experienced that many weekends.
I can only imagine.
All right.
See you later. Bye.
Take care, everybody.